let you know. Think I'm ready, baby. Think I'm ready now. Electricity. I see the moon, I see the moon, I see the moon. Oh, when you're looking at the sun. Not a fool, not a fool, not a fool. No, you're not fooling anyone. Oh, but when you're gone, when you're gone, when you're gone. Oh, baby, all the lights go out. Thinking of that, baby, I was wrong.
Good morning, everyone. I'm Nerida Gills, the National Sales Director for the developer team at realestate.com.au, and I'm joining you from my living room here in Melbourne. There are some 530 of you on the call today, and it is an absolute pleasure to welcome you to our webinar. As we adopt to new ways of working, realestate.com.au have introduced this webinar series to support you to ensure that you receive the best market insights, data, and the latest news to assist in navigating through these unpredictable times. Today, you are going to hear from REA Group's Chief Economist, Nerida Conisbee. Nerida is going to provide you with an update on the off-the-plan property market as it stands amid COVID-19, followed by a Q&A. I'm now going to hand it over to Nerida, who is in Sydney. Over to you, Nerida.
Thanks, Marini. So thanks everyone for dialing in. So today, as Marini said, I'm just going to run through a little bit of a economic update. I know there's a lot out there. I think the media is pretty much flooded with information at the moment. But I am going to talk through what we're seeing on our side more particularly. So we are starting to get some interesting data with regards to search activity, seeing what people are still looking at, what they're no longer looking at. And it's not all bad news. So, you know, I think it is overwhelmingly quite difficult for a lot of us in this environment, but there are certainly some bright signs in some parts of the market and also some sectors as well. So I'm just get my presentation up. This is seamless. So just starting with what the government's trying to do now. So you would have seen that, you've probably seen some pretty full-on data at the moment, particularly around the number of people that are going for Centrelink, those sorts of things. But basically what the government is trying to do, they're trying to stop job loss. And for those people that do lose their jobs, they're trying to support them through this time period. So there is an expectation that this will be over within 6 months or largely over within 6 months. So ideally, we just need to make sure that people can continue to live decent lives and not go into too much distress as we go through this lockdown. The second aim is really to support business and prevent bankruptcy. So we don't want people going into, we don't want businesses going into bankruptcy, not being able to continue to operate once this is all complete. And we also want to make sure that we also have available funds for people to be able to continue to go ahead and operate their businesses. So at the moment, this isn't a financial crisis. It's very different from what we've had in previous downturns. If you have a look at the global financial crisis, very much problems in the banking system. Also, the other part of it is, sorry, my presentation has just dropped out. I'm not sure what's happened there. The other part of it is that we just don't want the financial system to go into any sorts of distress. So there's lots and lots of stimulus in the market at the moment. It is equivalent to around 16.4% of GDP. To give you an idea of how much that is, it is 4 times more than the equivalent of what we were given during the global financial crisis. So that was equivalent to 4% of GDP. Lots and lots of different announcements. You would have seen them all. There's been 3 stages of the stimulus package. What's been good for property? there has been a couple of things that have been really good for property. The first is that interest rates are now particularly low. And the second is we've had these mortgage payment freezes. So this is really important because what it means is that even if people do lose their jobs, even if they do need to go onto JobSeeker, if they do see cuts in income, they are protected for 6 months in terms of their mortgage repayment. So it will prevent distressed sales and adds a lot more certainty into the market. What needs more work is a 6-month tenancy eviction freeze. It is likely we will see more announcements of that in coming weeks. Oh, I'm having trouble with this slide. Okay. For now, there's a lot of price forecasts being provided at the moment. I think the thing really important is that you do need to ensure that you ignore any forecasts for now. There's a lot out there. There's the kind of the doom and gloom scenarios that are starting to pop up in many places, and there's far more optimistic ones. The reality is that we are likely to see price falls in many locations across Australia, and we are also going to, we will see price falls, but it will depend on what location that you're in. So at the moment, there are a few things that are protecting us. The first one is that the government stimulus is unprecedented. And the second is, sorry, I'm having a lot of trouble with my slides. Okay. So it is quite different to previous downturns. The first one, or the most recent one, was obviously the Financial Services Royal Commission, where we did see big drops in Sydney and Melbourne. If you have a look back to the global financial crisis, that hit that hit Sydney premium markets very, very, very significantly. So that was quite different to what was happening in Perth at the time. Perth did see incredible rates of growth. And then if you go back to the 1990s recession, which really was a really bad recession in terms of the level of unemployment, we did see pretty dire circumstances, and what happened in Melbourne was quite different to Gold Coast. So Melbourne prices dropped significantly, whereas on the Gold Coast, we actually saw prices increase. So this is what will probably happen at this time around. We do expect that some markets will be hit more than others. And really the forecasts that I'm looking out for are any that are done at a micro level and then built up to a national level. Just looking purely at macroeconomic variables at the moment really won't give us a clear picture of what's happening, because the impacts will be quite variable when we have a look across each capital city and even within capital cities. So on to the next slide. And some of my early thoughts about what could happen with pricing are these. This is just some thinking. I mean, we don't realistically know at this stage where will be the biggest problems. I guess the first one is that if we have these mortgage freezes in place, these mortgage payment freezes in place, it will minimise, or not minimise, but it will provide a bit of a cushion in terms of how far prices will fall. So that's good news. You know, if we start to see very high levels of distressed sales, then that does lead to a very, very different situation in terms of property markets. There will be employment growth in this crisis, and you know, we have been concentrating on a lot of the job loss, and there's no doubt that there has been enormous levels of job loss over a very short period of time, but there are some parts that will see increase in employment. Health is an obvious one, that we are seeing an increased need for health professionals. And the second one is government. So you can't provide 16.4% worth of GDP of government stimulus without having some impact on employment levels at government departments such as ATO, Centrelink, Department of Health, etc. So there will be more and more government employees needed, and as a result, some markets that are very dependent on health and also on government will do quite well. The other side of the equation are those that won't do that well at all, and these are places that are very dependent on tourism. The tourism market has stopped completely. It will open up domestically sometime, you know, and relatively soon compared to international travel. So international travel will take quite a bit longer to come back into play. The education sector is another one that at this stage, at the moment, many universities are very dependent on foreign students. So University of Sydney, for example, has 25% Chinese international students. The longer term, or even the shorter term, we don't quite know how they'll be able to access the market. So it will impact any places that are highly dependent on education. There's two cities I think could potentially do well. One of them, we are seeing incredible data coming out at the moment compared to the rest of Australia, and that's Canberra. So Canberra is now seeing elevated levels of search across a variety of measures. I just had a look at some first home buyer inquiry data, and it's actually up 60% in Canberra, comparing March 2020 to March 19. So what we're seeing in Canberra is different. It is likely to be quite a shielded market in terms of what will happen over the next 6 months. The other market that could do quite well is Perth. So iron ore exports will hit $100 billion by mid-year, highest level of exports we've ever had. There is a rush to precious metals at the moment. They are considered pretty safe. So for now, we are seeing gold prices very high at the moment. And next year, Australia will produce the most gold in Australia, in the world. So again, most gold is being pulled out of WA. So very good for that market. So potentially Perth, already Canberra, we can see is performing quite differently. I guess on the other end of the scale, probably Hobart will be hit quite hard. And again, we are starting to see more negative data coming out of Hobart, primarily because their economic growth was driven a lot by tourism and a lot by education and entertainment. And given that there is a border closure and no tourism and very little education coming through, the Hobart market will be hit quite significantly. So on to the next slide. When we have a look at the market that is most impacted at the moment, it is really renters. So renters were hit really hard very quickly. Main reason being is that they're younger, they're lower income, but probably more importantly, they are more exposed to hospitality, tourism, entertainment, education. So those sectors that saw job loss very early on are very exposed to the rental market. So many have gone from a pretty regular income to maybe not no income. There is job seeker available and there's rent assistance and the like. But it is quite a dire situation that many renters have found themselves in. We are finding an increase in the number of people that are looking to share. So flatmates have seen an increase in activity. We've also seen, we are also hearing that a lot of renters are looking for alternative accommodation, such as moving back with family and friends. So that's having an impact on the level of search that we're seeing from renters on our site. So buy search is down a little bit compared to the same time last year. It's down about 6% at the moment, but when we have a look at rent search, it is down a lot more. I think it's down about 17% compared to in March 2020 compared to March 19. One of the problems with rental stress is that it will be passed on to investors. So if I go on to the next slide, here are some of the problems for investors. The first is that we are seeing a flood of what we think are Airbnb listings moving to permanent listings. So the number of furnished rental listings over the last 3 weeks have increased significantly. You can see particularly in Queensland, it has really accelerated. But New South Wales, Victoria, but probably the one that is seeing the greatest percentage increase is Hobart. So a lot of people have been investing in the Hobart market as short-term accommodation. The other thing though is more generally, we are seeing a pickup in rental listings. So there are more properties available, there's fewer tenants, and there is rising distress. And then we now have the 6-month eviction freeze. So pretty tough for investors, and still really no clarity as to how they will be able to cope. So whether there will be some tax incentives available to them, we're still pretty uncertain as to exactly how that will work. On to the next slide, you can see there in terms of listings, we're not seeing any signs of distress selling. So that's really good news, that on one hand it does increase listings, but on the other hand you don't really want to see people go into such distress that they're willing to take any price for their property. Again, going back to those mortgage payment freezes, they are providing a bit of a, or providing a big help to a lot of people that are going through these problems. We do expect to see fewer listings. That there's no doubt that this will be an issue. If you have a look at some locations, Italy, we have seen, there's a real estate institute in Italy have started reporting what's happened there with listings. It actually doesn't look that bad. Speaking to people working in the New York real estate market, they've seen around a 50% drop in March in terms of listings there, but I haven't seen any official data there. And then similarly, I was speaking to a colleague, not a colleague, my equivalent at Zoopla in the UK, and they're also expecting around a 50% drop of listings. But the UK market actually has gone into a property freeze, so you're actually not allowed to move or buy or sell or do anything over the next 4 weeks. So quite different to here, that although we do feel like we are obviously in lockdown, it is quite different to what's happening in the UK. So on to the next slide, just having a look at buyer activity. So what's happening with buyer activity? I spoke a little bit about that, it being 6% down on the same time last year. It's surprising me actually how much it is being maintained. I did expect a bigger drop off. But what seems to be happening now is that buyer activity is increasingly looking like what we see over Christmas, New Year. So that period in which we all have fun and take a break is looking quite similar on site to now. So it doesn't really feel like Christmas. It's quite horrible at the moment, but in terms of search activity, it does look a lot like that. When we have a look at where search is dropping the most, South Australia, a little bit hard to read anything too much into that. I mentioned Canberra. Canberra's up, so it is a very different situation in that market. Next slide, just looking at first home buyer inquiry. So we've actually seen, I looked at this data this morning in a bit more detail, looking on year. So we did see but we saw a 20% drop off in inquiry levels from first home buyers in March. But they are actually up year on year. So quite interesting to see this market. It's interesting, first home buyers, they don't like a strong market. They prefer to transact in a weaker market. Obviously, we are in a weak market. So although their activity is dropping off, it's quite different to when we were in that red hot investor market, when we weren't seeing many first home buyers out there at all. In terms of what they're looking at, you can see there, these are the top suburbs and property types that they're inquiring on. Important to the developer market, I think. Quite a strong unit focus, 50-50 on units and houses. Melbourne, CBD, South Yarra, Parramatta, St Kilda and Dee Why seeing high inquiry for units. And then you can see there a lot of house and land locations, so Schofields, Point Cook, Riverstone, seeing very, very high levels of first home buyer inquiry. So these are all inquiries on all properties, not just new developments. I'll talk about them in a sec. So on to the next slide, when we have a look at investors. We have, sorry, I've lost control of my slides. I'm not sure what happened there. We have seen a drop in inquiry. So the investor market hadn't really returned even before we had the lockdown midway through March. But investor email inquiry did drop off fairly quickly. But there again, it's not everywhere, and you can see there are some locations where we are still seeing fairly decent investor inquiry. So a bit of a Gold Coast focus. You've got there Broadbeach, Surfers Paradise, Melbourne CBD, Brisbane CBD. So there are certainly, it's certainly a very different market to some other locations where we are seeing a significant pullback in investor inquiry. On to the next one. Just looking at most in demand suburbs. So this is just an interesting one where we have a look at views per listing. What does seem to be happening from buyers is a push back to premium locations. What we were starting to see in February was that people were moving away from, not moving away, they're still looking in premium locations, but starting to look far cheaper. We are now seeing these premium suburbs, Hawthorn, Paddington, Newtown, areas that are pretty expensive are once again seeing high views per listing. It is likely because people believe that these areas hold value, so there is a lot of confidence for people buying in these suburbs. We'll probably see this continue as we go through the crisis, that the same way that people tend to flock to US dollars, they flock to gold. When we have a look at property, it's without a doubt people do flock to what they consider to be the safest property types. I won't talk too much. I won't be talking about commercial today, but what's interesting in commercial property is that we are seeing a real flight to farming. So rural and agribusiness at the moment is seeing quite a pickup in inquiry and search activity. On to the next slide, just looking at renters, pretty typical of what we see with rental demand. They are locations that are fairly low supply for new apartments. So Fitzroy North and Northcote, we have a relative undersupply of apartments in those locations. It hits the rental market, but also a little bit of Gold Coast still coming up there. So that southern Gold Coast down to Byron Bay area is an area that we have seen very strong levels of rental demand for quite some time, and as a result, it will slow down now because we obviously have those border issues between Queensland and New South Wales, but renters do seem to want to be in that location, and once this is over, we do expect that to continue. So next slide is just looking at offshore. Really nothing positive about offshore buyers at this stage. We were starting to see quite a bit of stability coming out of China. Actually, last week, Chinese search picked up a little bit, fell back again this week. It is a market that will probably come back, but at this stage, given what's happening in Australia, I don't think too many foreign investors will be too keen to buy here. Hong Kong is the other one, has been accelerating for some time, but even that has dropped off. The other interesting one is New Zealand. So they're not a big new development purchase type, but they have come back 30% over the past week. So it is significant. So New Zealanders are not that interested in Australia at the moment. Next slide, just looking at the views for new developments. We are seeing a pickup in Canberra and Sydney. So Canberra, again, coming back to this good news Canberra story, I think Canberra is up about 12% in terms of views. Sydney is up about 1% for views when we compare it February to March. When we have a look at last year, views are up a lot. So primarily because if you think back to where we were in March 2019, there was very few developments that were being announced, primarily because we were going through the Financial Services Royal Commission fallout, and also we had that election uncertainty, which was causing quite a lot of problems. So views are up compared to last year for new developments, down if we compare February to March, but there are some projects that people are still very active in terms of looking at. So the top one there, the most viewed new development, is the Harrington Collection in the Rocks, and that actually saw a 41% increase in views when we compare March 2020 to February 2020. But all of those projects are still seeing a lot of activity on our site. When inquiries, you can see there, a lot of projects really quite popular with first home buyers. So first home buyers, as I mentioned before, are much more active at the moment than investors. They really love Sydney House and Land. So what we were finding in Feb, when we had a look at February data, is this incredible push for house and land on inquiry levels, and very much Sydney focused. So Acuna Vista has pushed down to number 4. So still very high, but I think the top 5 nationally, when I had a look at the February data, were all Sydney House and Land projects. On to the next slide. Just a quick finish, looking at the most viewed rental listings, not as relevant for you guys being in the new home sector. Again, Canberra, we've got 39 Morehouse Street as being the most viewed rental listing, a pretty expensive rental, $1,200 per week, but interestingly topping the list. And final slide is having a look at the most viewed listings. So there is a, so we can go to the next slide. We've got a listing in Byron Bay. So this one, I don't think it is an Airbnb property that's been converted to or has had to be sold, but it is certainly a beautiful property, and I think there is still a lot of people having a look around on our site, not just to buy. You know, we do know that there are still active buyers out there, but also just to daydream about places they can be once this is all over. So I'll get Marini to come back on.
Thanks very much, Nerida. Look, I think as an industry now more than ever, it's really important for us to stay informed. And I think the data and insights that you've just shared, there is a number of takeaways for all of us here today. Moving on to the Q&A, thank you to everybody who submitted their questions at pre-registration. We've had to shortlist and consolidate. However, if there is anything that we have missed, there is still an opportunity to ask Nerida some questions via the live Q&A, which you can see on the screen below there. So Nerida, I'll kick off with question number 1. Having recently come out of the Banking Royal Commission era, which resulted in tightening on lending, do you know what the bank's current lending position is?
Yeah, I mean, they've been very vocal in saying that they are open for business. That their CEOs have come out and said that. At the moment, I mean, look, this isn't a financial crisis. I mean, the issue is that we can't work properly like we were able to a few weeks ago. So the fact that we have to work from home, the fact that we need to keep social distancing, impacts some professions more than others, and some professions, as I mentioned before, will come out of this pretty okay. The banks at the moment, they're open for business. They're not in distress. So, you know, I think one of the positives of this is that we've come in with a budget surplus, and we've also come in with a very solid financial sector, quite different to Italy. You know, Italy's banks were almost crumbling before they went into this crisis. So, you know, that's very problematic for them. But, you know, we're not in that situation. We've got a really strong banking system. One of the important things is that the banking system remains solid. You know, we don't want that. We don't want this morphing into a financial crisis, which it hasn't at this stage. The 6-month payment freezes, you know, mortgage payment freezes will help a lot of people. But there's no doubt that, you know, when people are going in for funding, that banks will be looking very carefully at their occupation. So, so I think if you are in an occupation that they would consider high risk, and I don't know what they would be because they would be putting forward their own lists on that. You will find it likely harder to get refinancing or get funding. But for those people that are in more solid positions, it's, you know, I think it'll be quite easy for them to, not easy, but, you know, it won't be as problematic to get finance as some other people.
Thanks for that. In your presentation, you touched on the GFC and previous recessions. Are there any lessons that we should have learned from those past recessions?
Oh, look, I think the main one is that, you know, this ends. You know, it's not you know, it is a health crisis. We can look to China to say, well, you know, they got through it. It's a horrible thing that we're having to go through. So there's no doubt that it's not fun. Like, none of us are having much fun at the moment. The fact that there's been so much money thrown at the problem is a good thing. You know, I think we'll come out the end and we'll wonder, you know, there'll be some policy decisions that were made that we'll wonder why they went ahead. But and particularly when we have to start paying all this money back, you know, that will be a little bit of a problem, likely to come through GST. But you know, I suppose that's the main thing, is like we need to remain positive. One of the worst things that happens during these sorts of crises is that people lose confidence, and understandably so, when you're worried about your job and you're worried about your family, in this case worried about your health. You know, there's no doubt that people do feel very nervous, but, you know, we will come out of it. Hopefully it's short and sharp, and with all this stimulus, that once it's over and we can start moving again, it will start working properly again, we will see a very sharp recovery going towards the end of this year.
Thanks, Nerida. On the 29th of March, the Treasurer announced changes to Australia's Foreign Investment Review Framework. How do you think these changes will affect off-the-plan sales?
Yeah, I mean, it's interesting, isn't it? Look, I think it's not meant to stop off the plan, and it is meant to stop any foreign company taking advantage of the fact that we are going through a crisis, a health and economic crisis. So one of the interesting things that I mentioned before around farming, I think food safety is probably a consideration that they're having, that we want to make sure that, if we have all this farming land and we're producing all this food, then, we do have access to it, and it doesn't, potentially become problematic if that farming land is foreign owned. So I think, and then there's things like our utilities and all the rest. I think the handling of off the plan will, I haven't looked in depth as to what the changes are, but I'd say the handling of off the plan would be quite different to anything that is considered national security or food risk or health risk or anything like that.
Thanks, Nerida. What effect do you think the government stimulus packages will have on the property market?
Yeah, look, I think that the main one will be that it will cushion the fall in terms of pricing. So, the very low interest rates at the moment, it's very cheap to get finance. If you've got a mortgage, your mortgage payments are, are relatively low compared to where they were a couple of years ago when interest rates were a lot higher. So, I think that's a good thing. I think, though, I mentioned it throughout the presentation, but I think the one that will really help out is the mortgage payment freeze for a lot of people. That if your income gets cut or you lose your job, then at least you've got 6 months to get through this until things start to go back to normal. But then all the stimulus in terms of ensuring that people keep their jobs. It was interesting. Bill Evans came out with some forecasts, which you do need to take into account, but it is very unknown as to what the ultimate impact will be on employment. But he had employment prior to the third stimulus announcement hitting around 17% or 17-18%, but he's cut it back to, I think, just below 10% because of that JobKeeper program. So there is, I think all the measures will really help property broadly, but more focused on property. It's obviously cheap access to finance, banks that are open for business, and the fact that if people lose their jobs, they will be supported in terms of payment freezes.
Question here on construction specifically. Construction is currently classed as an essential service with so many other industries relying on this sector. How do you think the economy will be impacted if construction stops?
Yeah, it's not great. I sit on the Construction Forecasting Council, and there's lots of issues. I guess the one that everyone was worried about a month ago was access to building materials. Now it's then a couple of weeks later is access to labour, and I guess the third one is now being shut down completely. It's interesting. In Italy, they've kept their construction sector open. Apparently, is what I've heard. So, at this stage, it's not. No doubt government will be considering it, and it would be one sector of the economy that they would be looking at closely. But at this stage, I suppose like a lot of people, I've been watching those COVID infection rates very, very carefully, and there was some better news that's coming out of New South Wales in terms of new cases. So, as long as that number of new cases continues to come down, I can't see government wanting to lock us down any further. So, fingers crossed that happens, and it all continues to happen as it is already happening, and we don't see any more adverse impacts on the construction sector.
Do you feel any particular segment of the market will be more impacted than others? For example, higher end property, downsizers, first home buyers?
Yeah, so I think first home buyers will be the ones that will probably remain more active than others. Coming back to the fact that they love a slow market and they don't like to feel rushed in what they're in their decision making. So this is giving them a lot of time to really think through any buying process. In terms of types of property, I guess premium seems to be doing pretty well at the moment in terms of viewer activity. I mean, we are hearing of people, waiting and watching the market very carefully to jump in and grab bargains. And I don't think we'll necessarily see that in the high-end market. I mean, I could be totally wrong, but at this stage, given what we're seeing on site, I can't see it happening. Investor activity will take a while to come back, and I mean, there's lots of challenges for the investors. I mean, the first one being is that we went into this crisis with, not a great, investors weren't back, they were starting to trickle back, but they weren't back to a large degree. But now with things like the 6-month eviction freeze, it will be making people a little bit nervous. Access to finance potentially if you do, or even refinancing if you do get hit by a tenant that can't pay their rent and you've got no income for 6 months. So the investor market will be a little bit tough. But I suppose on the flip side of that is that property is seen as a safe haven for some people. Certainly is a lot less volatile than what we're seeing in the share market at the moment. And if you're not someone that has much confidence in buying gold or precious metals, it's it is potentially something that people feel holds value. And look, it has in Australia for a very long time, so people have a lot of confidence in it. And we may see, or we are likely to see a lot of people feeling that property is somewhere that they can park their money, given the alternatives in which to invest in.
What is your forecast for development in regional Australia, for example, Mackay, and what impact do you think the climate will have on lending, more especially for Tier 2?
Yeah, so Mackay, I think Mackay's mining, isn't it? So Mackay was doing quite, I'm trying to remember, I'm thinking through Mackay data, it's quite specific, but what we are finding, or what we were finding up until around, I mean, we're still finding it, price growth and rental demand was very strong in mining towns around Australia. So, it does depend on what sector you're in. So iron ore, coal, precious metals would be the three. Copper, probably. I think, there's a few types of mining products that are very, they do continue to be in very high demand. So I can't off the top of my head think what sector Mackay is relying on. I think it might be coal, but China going into recovery tends to put in a lot of stimulus, and their stimulus tends to be building stuff, and to build stuff they need iron ore and coal. So that iron ore pickup that we can see very clearly about to hit $100 billion will also benefit the coal mining sector as well.
Do you think with the slowing of supply coming to the market, more buyers will look towards off-the-plan projects as we continue to have volumes?
Yeah, I mean, it's interesting. I suppose one thing that has come out of it is that off the plan have been better prepared for people to look at their homes or look at potential home purchases virtually. So, the fact that when you're selling off the plan, you're not selling, a product that has been built, you are selling a product that will be built. So, often the marketing material can be a lot better. In terms of what will happen, I think, the immediate market does seem to be first home buyers, that there's certain locations where we are seeing very high inquiry from first home buyers. We're also seeing some property types. Similarly, house and land out at Schofields, Kellyville, those locations are seeing very high demand. Investors, I think will be less active. I think that's a group that will take a little while to come back. I also think foreign buyers will take a little while to come back as well. So, the market is, it's probably not largely different to where it was in March, but, the heat really has been taken off in terms of inquiry.
We've got time, I think, for a couple more questions. So this one here, in your presentation, you mentioned international travel is likely to take a hit that lasts longer than the 6 months expected time frame. Is there any visibility to be lifted for overseas purchases and university students?
Oh, look, I don't know. I'm not a health professional, but I suppose just thinking it through that, if we get COVID-19 under control in Australia, it will be, it'll be Australia that's under control. And, the first the first restriction in terms of movement will be, allowing us to move around within our states. The second restriction to movement will be the states that have closed their borders, lifting their borders. So South Australia, Tasmania, Queensland, WA, restricting, again, opening up their borders. But the third one, international travel, I think, given that so many cases of COVID-19 were coming from overseas, I think it will be likely that we will have to wait for probably a vaccine. I'd say that before we'd be allowing people from overseas to come back in. But, it's such early days, I don't know exactly when that would be.
What are some of the leading indicators that yourself or people in the industry should look to understand or identify that would suggest that the problem is returning?
That's returning. Yeah. Okay, so I'll tell you what I've looked at. I mean, the one that we are looking closely at is buyer search. So we've been looking at that week to week just to see what's happening. Rental search we've been looking at. We're looking at listings, seeing how many properties are on market. We're also looking at inquiry. So inquiry, we can get quite deep down into projects that people are looking at. We can also look closely at suburbs. We can look at buyer groups. So, we are tracking that really closely. That data is not so good on a week-to-week basis. So, we're looking at that monthly. So the data on search, we're looking at weekly. Everything else we're looking at month to month. Pricing, I'll look at pricing, but it's not really going to be that relevant because, it's kind of after the fact. And, so for example, March, we actually saw prices increase. So it doesn't, really give us a clear idea. But a lot of the metrics on site, we're looking at closely. And if you go onto our site, we've got a section, a COVID-19 section where we've got lots and lots of material that our content team are putting together. I'm writing on there as well. Cameron Bush is writing on there. So, we are pumping out lots of content around what we're seeing on site and very much giving people access to that.
Brisbane's off-the-plan market before COVID-19 was an undersupply. Do you think that this would continue when we come out of this? And also, do you expect the migration trends of last year to continue after this?
Yeah, migration's interesting, isn't it? I guess so. Brisbane off the plan was doing really well. We were seeing a rental shortage in Brisbane, so that was something that was helping to drive the market. When we come out of this, it's hard. Look, the market will recover, obviously. Migration. Again, there's lots of variables here because, it does depend if Queensland, how soon Queensland opens their borders. I know Queensland did that for health reasons, but, I think it will, be a little bit more problematic in getting things up and running a lot quicker. There is undersupplied for housing. And at some stage we will need to, we will open up back to overseas migrants. I think one of the fallouts from Europe could be, quite significant economic problems. And, I mentioned before the problems with the Italian banks, that if Italy goes, further than a recession and sees incredible levels of high unemployment, we may start to accept more migrants from Europe because there's a humanitarian crisis. So, there's lots of things that could potentially happen. At this stage, obviously, Australia's shut down, Queensland's shut down, and it is really too difficult to tell.
There are a lot of questions. There's going to be final two. Do you expect downsizers seeing their superannuation taking a hit, holding off from buying or seeing their property as capital to access investment and look to move to a retirement community to free up capital?
Oh, retirement communities. Yeah, I don't know at this stage. My husband actually works in one, and so they are in complete shutdown. So they are, they are great places for older people to live in, very social places. And I think, the ways that they're handling the health crisis have been, really admirable in terms of making sure that residents are safe. So You know, I don't know exactly what will happen to that sector. You know, I think, yeah, it'll depend on a lot of things. I can't really predict it at this stage.
All right. Last question before we finish up. Do you have an opinion on how COVID-19 may impact off the plan property sales in the short term?
Yeah, look, I'd say, look, inquiries dropped. So if you have a look at inquiry levels, they have dropped. We've seen a pickup in search in Canberra. We've seen a little bit of a pickup in Sydney. There's no doubt people are holding back. You know, they're holding back on decision making in terms of what they plan to do. So, you know, I think you need to expect that we will see a slowdown in activity. But, you know, it will be highly variable across Australia. I mean, you know, I mentioned Canberra quite a bit today, but, you know, I think the situation in Canberra is looking quite different to the rest of Australia. And then, you know, you also consider segments of off the plan that, you know, if you're developing stock that's aimed at foreign students, you know, that's not going to be a great market for now. If you're located close to a hospital, you know, that's going to be better. The fact that if you're, you know, if you're marketing to first home buyers and you've got a good product that, you know, they can afford and they can access a lot of the first home buy grants and 5% deposit scheme, you know, you will see quite different market behaviour. So, you know, I think across the board, everyone will be hit, you know, there's no doubt, but there will be some segments that do outperform others.
Thank you very much, Nerida, for joining us, because we are out of time. I'd like to thank everybody who's on the call today. You will expect to see more of these coming through as we all work together to navigate through COVID-19. Please stay safe, and we'll see you again soon. Thanks very much.
Thank you.